I've been in the stock market for 5 years now, and just today I decided to start sharing a bit more about my journey investing. And of course, I do it for myself in order to track how my portfolio grows over time, to also evaluate the decision that I'm making in the moment, and of course, to just simply document my process while, of course, sharing what I do with you. And hopefully, you, as traders, you're also passionate about the markets overall. So, you should also be passionate about investing because this is one of the greatest vehicles to generate wealth. So I hope you're interested to see how I'm doing in terms of my stock investments, and I'm also going to break down how I currently invest in the current stock market crisis or crash, if we can call it that. So hope you're excited. Let's get into it. All right, so I'm gonna show you quite a few things today, but I want to start by just walking you through my journey overall, when I started investing and how is my portfolio looking like after overall 5 years of being in the stock market now. Here, this is a little website called Simple Portfolio. It is a great website to pretty much insert all of your transactions, and it's going to generate some data for you. Now you can see my very first kind of investment was made on November 11, 2019 for a value of 290 euros, right? But technically, let's just call it I have been investing since 2020. Now, a lot of people, a lot of traders, a lot of potential investors who really want to start getting into the market think that, hey, like 500 is not enough, $1,000 is not enough. You always have to start small and really just dip your toes into the game to really see how it's going. And as you start experiencing growth and compounding, then of course, the more you do it, the higher your portfolio is gonna go until somehow like you just go from nothing to a pretty large portion of a pretty large portfolio without you actually knowing how it happened. So again, I started in here 2020, right? Very small portfolio, just very slowly growing, like 300. Then suddenly I got to 1,000, right? So getting a little bit more into it. And you can see it has been growing pretty steadily, right? So 5 here, just reached 10K here in 2021. So you can see for 1 year, my portfolio pretty much hit 10K, which is the very first milestone everybody should be going for. Then of course it's 50K, then 100K, then 250, half a million, then of course a million, right? 2020, then this is, for example, the first time that my portfolio really started appreciating, and actually I started getting some profit from it, because this line here is actually how much I have invested, and this bluer line is how much actually the portfolio is valued, including the profits. Okay, so of course you can see 2022 starting to grow, just hit here 50K in 2023, and I was just around like 6K in profit at that time. And then of course during that very nice bull market here in 2023 to 2024, the tip of my portfolio reached around, yeah, I think 120,000. I can just pinpoint it right here, 120K or something like this. And currently you can see now, this is where I'm going to start talking a bit about mistakes, because again, I make this video kind of to recap on what I'm doing and the lessons that I'm learning so I can refer back to them later on. You can see that I was having a very big gap here between my between the actual cash that I had invested and of course the profit that I have made from the stock market. Now, of course, the first thing is you have to evaluate what are your goals, right? So are you investing to trade or like position trade to like buy some good stocks and then sell them at a higher price, or are you investing for retirement and for potential like really for 20-30 years to really allow for your portfolio to grow very massively? Okay, now what I believe I should personally be doing is closing some positions and taking a little bit more profit, because for example here that gap was getting pretty big, which means that a lot of my stocks were potentially getting a little bit overvalued. And right now where I want to take it to is to the actual profit and loss. Okay, so you can see again I wasn't making any profits here at first. My first kind of real profits from the stock market came here in 2022. So after 2 years of investing, okay, I was like sitting at 5K profit, okay, but those are unrealized gains. Now I was selling some profitable stocks here and there, but then I realized that let's say you buy a stock at 100 and then it goes to 200 and you sell it, right? And then you say, oh, I'm gonna buy it back lower. Well, then that stock goes to 250 and you never buy it lower. Okay, so take that lesson as well from me. Don't try to swing trade them way too much until you have like a very good portfolio number. So for example, my goal was to reach 100,000 euros, for example, in that portfolio, and then potentially start picking a little bit more aggressive picks, right, and start speculating a little bit more. But for example, here in so we had COVID here. Again, COVID didn't really affect me because I didn't invest much in COVID. This was my first kind of real crash, real crisis, and I was really frozen back there. Where is it? 2020. I actually, you can see I was actually running a loss here, very little loss, but I didn't do anything. Okay. Then here comes that 2022 to 2023 slowdown, where again I went from 5K profit all the way down to break even. Okay, and then from there I emerged very nicely towards 7K, and then of course we had another pullback here where I was buying a little bit more, and then the profit really started climbing very nicely until it peaked at around 35,000. All right, and look at what is happening right now. So I went from 35,000 of floating profits, of course, to 13,000, right? So I've lost around 20,000, and it's probably gonna get even more just simply by this very recent market crash. But now, of course, if you have a look at it, for example, like this, if I can do that, not sure, I hope it's recording, but here was where my break-even line was, and during this little crash here, the market literally pinged here my break-even price, but since there, the rebound was pretty big. Okay, so at that time, this piece of price action would have looked like, oh no, the portfolio is dying. So what is happening right now is exactly the same. Okay, the market is very nicely dipping, getting towards my break-even price, but then if it goes higher from here towards new higher highs, the return should potentially be double. Okay, so this is how it's looking right now. It's a super sharp, steep decline of all of my profit, which definitely doesn't feel good. I really wished I sold some from the top, but if you have a look at the value of my overall portfolio, right, it hasn't moved from 100K because I've been buying a lot, and I'm gonna break down what I have been buying, right? So if I've lost like 25,000 in terms of profit, then my portfolio should have been like 80K or 75K. Meanwhile, it's still like 107K. All right. Now, of course, here are some numbers. This one is pretty not good because it takes into account that massive flush that we're having right now. But overall, in terms of income, these are all dividends. So almost 2% per year with dividends. That is a 3.5K. And this is reinvested back into the stock market. So that's a little bit of a breakdown on where I started, how it's been going, and of course, that uptrend and the current situation with that massive loss. So let's right now go to the actual stocks that I own and start breaking them down. And I'm going to share with you a little bit more about my current investing thesis and how, of course, I'm picking those stocks and managing them. All right, so here we are at my stockbroker. You can see my portfolio here. I invest in the Giro, or the Giro, as they would call it in Dutch, because it's a Dutch broker. And pretty much you can see again, this is the portfolio value, 102K, and this is the total profit overall. And this is how much I'm down for the day. I have been down 5 to 6K every single day right now for the the last like 2 months. It's been crazy. But overall, just to give you a very brief insight into what I'm investing in, it's mainly tech companies, very good blue chip companies. Blue chip companies are very well established, very stable with a wide economic moat. Leader in the pretty much within its industry, but I have made some very recent investments. Usually the ones that you see right now that are red, these are almost all of them are recent investments. And just this year I started buying my first shares in Google, Amazon, Nvidia, where is Palantir, right, and Salesforce. So those are all new companies and they're all looking red right now. But overall, again, you can see Google, Amazon, Apple, Coca-Cola, JP Morgan and Chase, Microsoft, Nvidia. This one is some random stock that I received for free. Palantir, Procter & Gamble, Prologis. This one is an industrial real estate. This one is more commercial realty income. They're called REITs, Real Estate Investment Trust. Salesforce, Visa. Very good investment of mine, but right now it's really falling down a lot as well. And Waste Management, right? So very nice defensive stock. But the big bulk of my portfolio is located into the S&P 500 index. Okay, I invest in VUSA, VUSA, and this is on the Amsterdam exchange because this is what I can buy from this broker. And you can see right now I am just up 10% on that investment, right? And total P&L of 4K. And pretty much I have, like, if my portfolio is like 100,000, let's say 37 of that, so 37% is into that ETF. And this is how I like to spread it. I really like to even boost this one to 60% of my portfolio because, again, my goal is to literally invest for the very long term. And the best investment for the long term is literally the S&P 500 because this index is literally designed to grow, right? Those are the best 500 companies in the US. If a company does bad, it's going to get removed. It's going to get replaced with a better company, right? So this one is literally designed to grow. And this is why I'm going to explain to you, it's always good to buy it aggressively when it's going down. But overall, this is my portfolio. Very simple, very nice. A lot of them are running into profit because I've invested very early in them. And literally all the red ones you see are investments that I did literally this year as the market is dropping. Apart from this one, apart from Realty Income, this one I have been stocking a lot. This Prologis one was a bad investment. I actually want to cut it while the rest are good. So right now I actually want to take you to the charts. So I'm going to put my charts in here. And I want to start with the S&P 500 index, because again, this is extremely important to look at right now. And I very quickly want to zoom out a little bit and show you pretty much what has been happening in some of those crashes that we've had, of course, along the years. There is the financial crisis here in 2008, right? And you can see we had this very nice drop. And then since then, when did the market go? It went up. Here we have the 2015 to 2016 crash here. The market again crashed. It went back up. Here is Trump trade war 1.0, right? The market dropped. Where did it go? It went up. Here is COVID, right? Went down. Where did it go? It went up, right? So what I'm trying to show you is that the market always ends up going up. The S&P 500 index is always designed to go up, right? That's a fact, and that is a pretty good fact. Why is it like this? Well, first, because of inflation, okay? As the prices of the companies are growing, the index is also going to be growing. Companies are always evolving. They're always thinking of new things. They're always like new companies as well emerging that are growing a lot, adding to this index. So it's literally designed to track the best 500 companies, but you probably already know this. Now, how I view that current crash as well is I put it in perspective of what has been happening before. Okay, so if you have a look here at this at the financial crisis, which is something that I don't really think it's gonna happen right now. By the way, nothing I say is financial advice. Okay, so I'm just sharing what I do and what I know. So I'm not gonna make you buy any stocks, right? But here we dropped 58%. And we did this for 518 days, which is a year, almost 2 years. Okay, but here we had a pretty big panic, right? Financial crisis, banks were going bankrupt. It was pretty bad. Okay, so can we have something like this right now? We could. We always can have something like this, but I don't think we're gonna have it right now, potentially, right? Again, I don't know. And then of course you can see if you were just buying on the way down, eventually from the bottom to the top, right, you're making 130%, right? So always think about the upside as well, because it was designed to go up. And then of course we can have a look at this guy here. This one was you can see a very nice consolidation here on top. Again, stocks probably getting overvalued. I always think that there is an agenda for the stock market. Always something is going to happen when the market is getting overvalued. And I'm going to show you a tool on how to measure the undervalued or overvalued for the S&P. But here we dropped just 15%, but it took a very long time. So it took a year for us to make the bottom, all right? And then again, from the bottom, we started climbing very nicely higher. Then here again, trade war 1.0. This one, I want you to really look at the price action, because I do expect a lot of traders to be watching this video. When you have such a sharp move, what does it usually signify? It signifies manipulation, right? If you're having a very stable downtrend to the downside, like for example, like we had here, right? That's not very fast. Like it made lower lows, lower highs, lower lows, lower highs. Like it's a pretty nice and smooth downtrend, right? But look at COVID and look at Trump war 1.0, the tariff war, the trade war, whatever, right? Massive drop. Where to? The 200 simple moving average. This is what I use for, it's an extremely good indicator, especially if you're looking to buy stocks when they're undervalued. Now here I am on the weekly time frame, and the weekly time frame really, if it reaches that 200 simple moving average, it usually tends to bounce, right? So we went very fast here, and it only took us 100 days. Okay, so roughly 3 months and a half. Okay, look at COVID. Absolutely crazy drop, around 35%. How much did it reach us to reach the bottom? 42 days, a month and a half. And then since then, we absolutely rallied. Now, of course, here, the Fed stepped in immediately to cure the economy. They started printing money. So, of course, it immediately started going higher. But I just want to show you, like, fast crashes like this usually tend to bounce very well. Now here again, stocks got super overextended. Inflation was very high. The Fed had to start, of course, taking a look at the results of their, pretty much as they here started printing money, cutting the rates, blah blah blah, to stimulate the economy. Here they actually suffered the consequence of that, and here is what really a nice slowdown period looks like, right? So it took us a year of a downtrend to literally reach the bottom. When where did the bottom come in? The 200 simple moving average once again. And then you can see since then it also took us a very nice and steady climb to the upside, but it still climbed up. Okay, and then here and there we had like little dips, so those are great buying opportunities. This is where you're going to be buying potential on the daily time frame 200 moving average. But look at what is happening right now. All right, so if I just take it like that, okay, since the top to the bottom we're down right now 21%, and we have entered a bear market. Now technically you should have like a weekly or a daily candle closure below that 20% drop to really say, okay, right now the S&P is in a bear market. But I can say we are, right? And the market usually tends to bounce when it enters bear market, which is quite crazy. And it has been 48 days. So it's been around a month and a half since the market has been dropping, okay? So I am, again, based on what we just covered, right? So are we going to be having like a slowdown like this? We definitely could. If Trump doesn't really remove the tariffs, if the US market really enters into like into stagflation, and if really the job market slows down, if like we have all of these slowdown metrics that of course we're going to see through economic data, I think we can potentially enter like in a prolonged like consolidation or a downtrend inside, for example, this range, okay? But if Trump surprises us by lifting those tariffs, and maybe they reach some agreements with the countries and all that, at the end, like it could seem like, oh, he was just playing with us. He was just like using this as a negotiation tactic in order to drop the market. Because why? Let me show you why, right? So I'm just going to go quickly here to this market mean value calculator. So this shows you, right, since January, so since 1980, even before that, this is the whole pretty much the stock market since it exists. I'm not sure if that is the case, but whatever, it is a lot of years. And this has a formula to calculate the mean value, so the fair value of the S&P 500 index. And you can see it visualized by this red line. Okay, so look at this. Anytime the market was trading below that red line, that was a great buying opportunity, and the market always pretty much went above it. So when it goes above it, that is overbought, right? That is overvalued market. And then usually something has to happen in order to bring the market down, right? If of course you study the past, we had oil crisis, financial crisis, we had COVID, we had the tariffs, we had this, we had that. There is always something happening to bring the stock market down, because it works literally as a pendulum. Goes up, goes down, goes up, goes down, right? And you can see here again, we reached a little bit overbought, if you like to call it. What did it do? Right, pulls back immediately below the red line. You start buying it, goes above, pulls back again, goes above, pulls back again. Now here again, you can see. So why did we have the 2000 here crash? Right, where is the 2008? Yeah, 2008 is here, but here there was also another crash. Right, this is the .com. Yeah, I think it should be the .com. Right, why did the market flush so much here? Right, do you see the red line? It was very far away. Right, and again, this is why I think there's always an agenda for something. Of course, we had that crash, and of course, the market brought us back where to? Exactly to the red line. And since then, we recovered. Then, of course, the market dropped even further. That was here really the financial crisis dropped the S&P. This was probably an incredible opportunity to invest for absolute generational wealth, because we were so much below that mean value at that time. But maybe at that time, the calculator would have showed something different, because we didn't have so much price action at that time. But then you can see since then all the way to pretty much 2021 here, we were sitting below that line. And here we had, of course, COVID to dip us a little bit, but then for the first time we emerged above, and that is when that slowdown in 2022 to 2023 occurred, dipped us below again, and right now you can see we are back above it. So the market was overbought, and we are just starting to tap this line right now. Now, of course, it can dip a little bit further, which is what I think it's gonna go, but currently, like, the 50-year mean of the S&P is this price, 5250. You can of course copy it on your chart if you want, and we are 5.6% below that. So if I just take you, for example, to the chart, there is the latest 50-year mean. All right, it has actually moved up a little bit, and currently we're below around 6%. Now, usually 10% below the 50-year mean which is what I have studied and what I have found out and learned from mentors as well. 10% below that mean is a great buying opportunity. Okay, and 10% below the 50-year mean is perfectly aligning, for example, with the weekly 200 moving average, right? That is just coming here, very close to that 50-year mean. So this is, for example, going to be my next buying opportunity on the S&P, which I'm going to show you right now in a bit. But overall, again, like this one can continue to make another lower high, then drop for a new lower low. But I do expect it to start stabilizing here without this sort of area right here. Okay, why? Well, because we can also study the 25-year mean. So this is a little bit more recent. Okay, and you can see the market is still 13% away from that mean. Okay, and you can see here the market, I don't like this way too much. I really like the 50-year mean. Here again, it dipped very nicely. It took a lot of time to recover, dipped again here during COVID, recovered again. The slowdown came a little bit lower as well. Right now we're very far away, so again very extended, and we can come potentially to also tap that 25-year mean, which is at this price 43.58, and if I take you to the charts, that is somewhere here. Okay, so we can definitely from current price dip another 12%. So these are kind of my expectations in terms of technicals. Now, of course, I'm not a very big fundamental guy, but I've been reading a lot. It really depends, of course, on how Trump is going to proceed. It really depends on how other countries, of course, are going to respond to this, right? We can see China is retaliating really hard, which is super interesting to see. But this is overall how I think about the S&P 500 index right now. And I still do believe we have a little bit more downside here all the way towards this area of, let's say, 4,800 here all the way to 41, right? So that is a pretty big area here, around 17%. But pretty much if we take it from the top all the way to this bottom, that is like a 33% drop. Okay, so I think that could be enough, but who am I to know? So I'm immediately going to show you, for example, how I've been buying, my strategy for buying the S&P right now. I used an advanced dollar cost averaging technique. This is kind of something that I came up on my own, because usually the normal dollar cost averaging is, let's say, okay, I'm gonna invest $10,000 in total this year, and then you separate that amount in same quantities, right? So let's say I'm gonna invest I don't know, $1,000 every month. Okay, so every month you buy, every month you buy $1,000. Okay, or let's say you're gonna do twice $5,000, right? So maybe you deposit 5,000 at the beginning of the year, and then 6 months again another 5,000, right? It's the same amounts. Okay, but what I'm doing is, as the market is dipping, I keep increasing my dollar cost averaging, right? So for example, here you can see this is the actual index fund that I'm buying. It's an ETF, right? So I'm always buying these dips here. Okay, but right now I'm not gonna really look at that, because since the top right here, right, we first dropped below this liquidity level here, and what did I do? I bought 6 shares. Okay, but then the market pulled back. All right, looks good. I thought it's gonna maybe start continuing, but then we dropped another. So we dropped 6% from the top. Okay, so usually in an uptrend, I'm always buying on 4%, 6%, and 8% dropped, and 10%. Okay, and I still increase the amounts as it's dropping lower. So you can see I went from 6 shares to 10 shares. All right, so the more it drops, the more I increase my share price, the more I increase my monetary value, of course, of my investment, in order to get a better average price. Because if I deploy all my shares here and then it keeps falling, not good. If you do regular kind of investments, so let's say 1,000 euros here, 1,000 euros here, 1,000 euros here, you're of course gonna get an average price at the end. But if we increase them all the way down, right, your average price is always going to decline a lot. So you're going to be very close to the potential bottom of the market. Now, I'm not trying to catch the bottom, okay, but I'm very strategically deploying capital to, of course, try to catch it. So again, dropped here 6%, bought 10 shares. Dropped another, so again, dropped to 10% here from the EMA, right, on the daily 200 EMA, 200 simple moving average. Always a buying opportunity, bought 10 more. And then you can see it drops 12%. Here I bought 20. It dropped another, right, 13%. I bought 20 again. And I'm using, for example, levels like this to the left. These are liquidity levels, like support and resistance levels, right? You can just drop like a support and resistance line here. You can see support became resistance, right? Just very simple, not really using a lot of too much technicals. I do use a lot of things, but I'm going to try to keep it simple, right? And then the market recovered very nicely. And you can see if I calculate my average price since the top, it should be roughly down there, right? And then when the market starts moving up, you are almost immediately on profit on all these investments that you made. Then the market started dropping once again a lot, right? So it reached the next level, which is 17% drop. Look at what I bought. I bought 31 shares right now. So I keep increasing my buying amount in order to keep getting a better price. And the very recent thing that the market did is it crashed 25%, and I bought 28 shares. I would have bought more, but I didn't have capital in my brokerage account, so I couldn't deploy it, right? And you can see this one literally immediately responded very nicely, right? So my average price right now, although I was buying from the top, my average price is looking pretty good, right? It's not up here, but it should be somewhere around there. I'm going to calculate it, of course, at the end. But yes, so right now so this is my average price. What really sucks is that, of course, I've been buying and holding that index for such a long time, and just a very big drop like this can put me back at break even. But of course, as I'm buying on the way down, when this thing goes up the next time, I would expect, like, for example, double the profit than what I had made, for example, at the top right here. And of course, I will be right now looking at the S&P index. If it drops right now to 47.25, 10% below the mean, I will put another big buy. Okay, and then if it goes all the way down to that 25-year mean, I'm gonna put even another bigger buy. Okay, and then pretty much I'm gonna be looking to stop and wait for the market to stabilize and maybe start turning into an uptrend, where you can, for example, start buying again on the way up and really maximize the return that you're gonna get at the all-time highs. Okay, so this is how so this is kind of the index fund part. This is how I invest in this in the S&P 500 ETF. I do plan to invest a little bit more into that one as well here. This one is kind of a high dividend yield, but it's not growing a lot. It's paying some very good dividend, but it's you can see when it crashes very big. So I'm not loving it. So definitely the S&P 500, amazing place to be putting your money. And of course, you can consider using a strategy like this, but again, not financial advice. So let me also walk you through how I invest in these other individual stocks, and also a little bit of my process on how I pick them up. All right, so let's talk about individual stocks and also looking into their fundamentals, and just give you a very brief kind of tutorial of a very fast way that you can evaluate a good company. But before I do that, check out this CNN fear and greed index for the stock market. We are at extreme fear of 3. This is a number that we do not see very often. All right, the market is absolutely fearful right now, getting very close to the 0, and we haven't really been that low, right? Every single stat here is extreme fear, and as Warren Buffett says, right, buy, so be greedy when the others are fearful, and be fearful when the others are greedy. So once again, a great time for a generational opportunity. Now, I use Finviz. So that's one of my favorite websites to be, of course, researching stocks and having a very quick glance at their fundamentals. I use this app called Qualtrim. This is created by one of my favorite YouTubers, Joseph Carlson. You can check him out. I watch him a lot. He actually inspired me to start talking a bit about investment, because he's been tracking his decisions and what he thinks at the market at different states. And then, of course, you see how correct he was to actually invest during those times. So I kind of want to make something different. So check him out, Joseph Carlson. Qualtrim is his app. I use Yahoo Finance, right? And pretty much that's it. You don't need a lot. Very simply, right? So let's for example, check out Google, which is a company that I have been stocking a lot with. I did move my camera a little bit here so you can see all the charts. But I started buying Apple here on this drop. Okay, so I actually bought it a little bit earlier in 2024. I think I bought somewhere here. Okay, I do have some markups here, but it doesn't matter. Then it reached all-time highs. Okay, I didn't sell anything, and then it started dropping. Okay, so again, if it drops, for example, 10%, I'm always gonna buy a good company on a 10% drop. And then of course it keeps dropping to the EMA, and then of course it starts taking all these liquidity levels here. And again, you can see I applied this dollar cost averaging as well in individual stocks. Again, 5 shares on the top, 6 shares here, 9 shares, 5, and then 12 shares at the very bottom here, right? So this is a very important liquidity level here, filling that little gap to the left, right? 12 shares. So that 12 shares, my average price before I bought these 12 shares was like, for example, up here. So if I buy a lot more when it's close to the bottom, that immediately got cut down. So I do plan to buy a little bit more if it continues to drop, for example, to that Next liquidity level, I use also a lot of VWAPs, but of course, I'm not going to talk about that. But for example, you might ask, okay, so why are you investing in Google? Well, of course, like Google is Google, but first thing that I do is very simple. So I go to Qualtrim, right? And you just type Google, for example, right? What is a good company? It's a company that is making money, right? It's profitable and is growing. That's it. Does the company make money? Yes. Is it growing year over year? Yes. That's a good company. Of course, there are so many more things, right? It needs to have an economic moat, right? So it should be hard to replace by competitors. It should have a network effect, right? So is everybody using Google? Yes. Right? Is everybody using Facebook? Is everybody using YouTube, right? Is everybody using Apple and stuff like this? Yes, right? So these are monopolies in the market and very hard to disrupt as well. But overall, when you log in here, like the first thing again that you think about, so are sales growing? You open the revenue chart, look at that. Beautiful uptrend, growing year over year over year over year. You can even see the growth here. That's check number one. Is the company making more revenue? Yes. The next step, of course, to check in, is it actually making more net income? So after expenses, after taxes, right? Is it? Yes, it is. They're growing. They had a little bit of a slowdown here in that slowdown period of 2022 to 2023. But of course, they keep making money and they keep growing. All right. And then, of course, you check the free cash flow because cash is always king. One of my university professors used to say cash is king, right? In our accountancy and investing classes, right? Cash is king because cash doesn't lie, right? Did you make money or not make money, right? Because other things can be manipulated, but cash cannot be manipulated. And we can see their free cash flow, this is cash, of course, available to them, has been growing. Again, there was a little bit of a slowdown, but is it growing year over year? It is growing. Okay, so these are the three most important things to check about the company. Is the revenue growing? Is the free cash flow growing, right? And then, of course, you can check earnings. You can check other things like, for example, revenue by segment, like Google search, YouTube apps. Are these stuff growing? Yes, they are, right? The other thing I really want to see, to have about the company is for a company to be lean. And what does lean mean? Is to have like very little debt. Okay, to have like as little employees as possible, to be spending as little as possible, but of course to be generating as much as possible, like a lean business. And you can see here Google on their very quick balance sheet. I'm gonna walk you through Finvis and the Yahoo Finance, right? You can see Google has $95 billion of cash and they have just only 8 billion of debt. Like that is an incredible, pretty much cash to debt ratio. Absolutely incredible. So they have like all of that cash just sitting ready to be invested in AI, right? And if we have a look at their expenses, they have been spending a lot, right? On CapEx, sales, marketing, and of course, research and development. Like look at R&D here. That is this, the final line, right? 13 billion and research and development. And that is mainly going into AI, right? Their shares outstanding are slowly declining, which is also a good thing because then your shares are going to get a lot more value. Again, cash versus debt, very big difference. That is a great company anywhere, any point that you look at, okay? And then, of course, another point that you should look at is the PE ratio, okay? That is how much the company is currently kind of valued at. If you think about a business, for example, a private business, they usually get valued like 3 to 5 times their earnings, their revenue. But public companies, they usually tend to be valued like 15 to 25 to sometimes even 30 times their earnings, okay? Google, for such an incredible company, it's being valued like 17 times PE ratio. And if you check the averages of the tech sector, like 25, 30, this one is selling currently extremely cheap, okay? But then another thing you have to look at, because just looking at the PE ratio is not enough, you have to look at this PEG ratio, which is comparing their PE to the actual growth the company is projected to have. And you can check out this here, right? It is expected to grow by 13% in the next 5 years, all right? And then, of course, that I think this divided by this is going to give you the PEG ratio. And if this PEG ratio is around 1 and it's not above 2, it's not above like 1.6 probably, it is a very good opportunity, all right? And of course, you can look at a lot of other things, but these are the main things that I'm immediately looking for a stock, right? And then, of course, what I said, you can also go to Yahoo to do some more research into their financials. So there's, for example, again, Google. and you can just very quickly go to their financials. And there are a few things that I'm checking here, just very quick. You don't really need to be a super big expert on reading financial statements and stuff like this. Again, like the first thing that I really always look for a company is to not have a lot of debt. Okay, and I'm actually gonna tell you why, right? I can immediately do it, of course. Just to explain myself, is I'm gonna go to a website, this one, okay? And here you can, of course, this is a very nice AI tool that was available even before the AI revolution took place. But here you can do a lot of formulas. And what I really like is this formula here. Okay, so I just have to replace PG with Google, right? And then just copy this and do that, right? And just hit enter, okay? So this thing shows us how much time will it pay for Google to pay all of its debt just by their earnings, okay? And this should be below 4 years, okay? You can see they can pay all of their debt just for 1 month. And that is absolutely crazy, right? If we check like a company that has a lot of debt, like what would have a lot of debt? Probably like a real estate company, I guess. Let's just do realty income. If it appears, sometimes it doesn't really catch the ticker symbol. No, it didn't catch it. Okay, let's try PLD here. That's not available. Okay, come on. But you get the point, right? If it takes them a very long time to pay their debt by their earnings, a very bad company. All right. So here again, this is why it's important, right? You check their total assets, 450. You check their total liability, 125. That is amazing. Okay, you do not want the liabilities to be more than the assets because then they have a lot of debt. That is the first thing that I check in their balance sheet, all right? Are their assets growing? Yes, they are. Check. Are their liabilities good? They definitely could be growing, but they should not really exceed the asset. Amazing. Then, of course, you check out the income statement. Are they making money? But I really check easily here from Qualtrim, right? They are making money. But, of course, you can see it, total revenue here growing. Then, of course, you have the operating income is important. This is actually the actual one that they're making. Again, are they making money? They are. And then, of course, cash. Cash is king. Operating cash flow here is very important. Is it growing? 91, 91 didn't grow much here, 2021, but still it didn't really fall as well. But then here, 101, 125, it is growing. Okay, so good. Google is a good company fundamentally. All right. And then, of course, after I do all of that research, right, you just go on the charts. I, of course, also do some calculations about what the actual valuation of the company is. And based on my calculations, Google, based on the cash it's generating, it is actually worth $223, okay? And if I believe the market is going to reach there, for example, from current price, that is a 35% increase. So I'm always going to be buying companies that are below their intrinsic value. Now, of course, how we can calculate this, it's discounting their cash flows and stuff. This is a little bit more complex, but this is just breaking down one company and how all the simple things that I look for it in order to invest in it, right? And for example, Amazon has been another company that I also have been stacking in with an intrinsic value of 221. So anytime the market drops below that value, I'm buying, okay? Again, my first investment was made here, 4 shares at 15%, 8 shares at 20%, 10 shares at 25%. And if it drops a little bit lower, I would definitely deploy probably a lot more because I really want, so this is my average price here, right? I really want to bring this down as close as possible here to the bottom, okay? But once again, so what do I do for Amazon? We go first, like we can first check out this one as well, Finviz, right? And you can, of course, check out Qualtrim, which is usually the first thing that I check, right? Is it making money, okay? There's the revenue. Is it making? Check. Absolutely beautiful, right? Revenue by segment. Are these things growing? Yes, they are, right? So AWS, Amazon is not only selling like goods, they're also selling subscription services, advertising, cloud services as well, right? Commitments growing, so their business is growing, right? Absolutely perfect. Are they generating cash flow? Now, Amazon is not a cash flow company. Jeff Bezos loves to invest in a lot of things for the very long term. So anytime they make a cash, they immediately deploy it to work. All right, which is what I really like about this company, because it's still, after existing for such a long time, it's still a growth company. And a growth company is a company that doesn't pay dividends and really invests very hard in their processes, in their infrastructure, and in everything. All right, but again, cash versus debt, they do have more cash than debt. That is important. And of course, the net income, has been growing. Of course, here we had a very big slowdown where they did a lot of investments, of course, for their warehouses and stuff. But is it growing? It is. All right. So again, everything looks good. Also, profit margin. I forgot to say, usually you want to see a pretty good profit margin. Like Amazon has a little bit of a low profit margin, but that can, of course, grow going forward. Again, do they have more cash than they have debt? They do. Check. Okay. Now, of course, the next thing we check is the PE ratio, which we check here in Finviz. Okay, so current PE ratio of 30, right? So remember, Google had 18. So this one is selling at a pretty high PE ratio. But if you have a look, of course, their expected earnings are 20%. So if you pretty much divide this by this or this by this, I'm not really sure, that gives you the price to earnings to growth ratio of 1.57, which is just kind of on the baseline of what I would like to see. I would want it to drop below 1.5. Usually you get some very good deals if this one is below 1.5, right? But is it looking good? It is, right? And then you can immediately go and check. I think you can also do it here, but I don't like it. You don't get a lot of data, right? Do they have more assets than they had debt? Do they have growing cash flows? Do they have this? Do they have that, right? And then you fundamentally determine that this company is good, okay? And then, of course, I go to the charts immediately and I start buying it. When do I buy it? When it's dipping, always. And I apply this dollar cost averaging technique on the way down in order to capitalize on a very good average price, all right? So I've shared a lot of things so far. If you really want me to make some more tutorials or talk a lot more about like how I invest and like all the other things I'm doing, let me know down in the comments if you would like to see more stock education, right? Just let me know. But I just want to end the video with breaking down my watch list, what I'm looking for going forward, also to keep reminding myself. Palantir has been a company I discovered very recently. My first buy was here on that gap, right? Which was a 20% drop, and I thought 20% drop is incredible, but right now this dropped like 50%. Okay, I bought 9 shares here. I bought 4 shares on a bigger drop because I was still uncertain of the company. The company has some financials that I'm still not sure of, and I do believe it can drop a little bit more towards the daily moving average here. But of course, my next buy on Palantir is gonna be here on 64 under this major swing low. Amazon, I do plan to so I've been investing 4, 8, 8, 10. I do plan to start scaling like 14, 15, maybe even 20 shares if it drops a little bit lower, because I really want to stack up on Amazon and I really want to stack up on Google. I really want to bring my average price down on Amazon and Google because I've been buying the dip, but of course the dip keeps dipping. This is why it's always good to wait for the market to consolidate and stabilize and of course start shifting into an uptrend. That is the best time to buy, but I'm not fearful to be buying dips as well. Of course, that is up to you. I just yesterday bought Apple. Apple is a little bit still overvalued. It is really being hit by these Chinese tariffs because, you know, again, the iPhones are manufactured in China and then, of course, shipped all around the world. And if, of course, there are 100% tariffs from China to the US, right, it's going to be pretty hard to import some iPhones. So, of course, you can see Apple right now from all-time highs is down 35%, which is an incredible drop. And it's getting very close to my average price. But, of course, I bought 3 shares on a small dip. I bought another 3 shares on, again, a small dip. So 10% drop, 18% drop. But I just yesterday deployed 10 shares here at a pretty significant drop here, 35%. And, of course, if it drops a little bit more here, I'm really looking at the PE ratio of that one. Like if I just very quickly take it to Finviz, oops, right? The PE ratio on Apple is still a bit too high for me, like 27 with a PEG ratio of 2.9. You want to see that PEG ratio to be definitely below 2, and this one is 3, right? You can see that the earnings are expected to grow by 10%, while people are paying like 30 multiple for the company. It's definitely, I feel like it could drop. This is why I didn't really buy it aggressively, right? Just 3 shares, right? I'm not really going massively crazy as it's from the top. But now as I start seeing that PE ratio drop below 25, maybe get to 20, right? I will be looking to buy Apple anywhere, for example, within this area. Nvidia, this is also a super new company for me. I am super sad that I didn't really buy an Nvidia as it was somewhere down there. It grew massively. But again, I first bought like, I bought my first shares at 16% drop. My first buy was here actually at 22% drop. So 8 stocks, then I scaled 6 and then I haven't bought it anymore. So I absolutely should be buying more Nvidia right now. No, I should have bought because my average price is down there. Huh? I maybe missed to document something here, but oh yeah, I bought 10 shares here. Yeah, there it is. So I literally bought 10 shares here at the bottom, and I literally got the bottom. Look at me, right? But that's really not the aim. It retraced very nicely. So right now, if it keeps dropping below that low, there I have two more levels here of support or liquidity that the market could react from. The market is way below the daily moving average, which is great, and probably on the weekly. Now the weekly is a little bit too far away still, but I will be looking to buy more Nvidia, another great company. If you also check out its financials, right, it's still in a very early stage. I believe if the AI revolution is going to kick place, Nvidia is going to be a key, playing a key role into that. So pretty much around like 84 all the way to 75, I will be buying more Nvidia. JP Morgan, this is an investment. This is my first investment that reached 100% profit. There is my average price. It was sitting at 100% profit at a time, and I again didn't sell anything because I'm not doing this to buy and sell. I'm doing this for the long term, but I did realize right now it's actually important to do a little bit of selling to stay cash and then of course buy it back again. Now here again, you can see I'm scaling very slowly. So 2 shares here, an 80% drop. That is a weekly imbalance, reacted. 3 shares on 12% drop. So I guess I bought it again. 3 shares on 18% drop. That is right here. The market pulled back very nicely, but it's holding these flipped VWAPs right now. Massive flush again. I did not buy it down there, which I regret. But right now it's definitely gonna come in again. So I will be doing more buys around 208 to 200 price levels. I do think it can definitely keep flushing towards all of these levels here. All right. But again, usually right now you also have to be investing a little bit more into companies that are not going to be so affected by the tariffs, like financial companies. People are still going to need to take money out of the bank, right? Amazon, that's going to get affected. Apple, that's going to get affected, right? So these are going to offer some amazing discounts, but they're probably going to take a longer time to recover. But for example, Google being like a digital company, you're still going to watch YouTube. You're still going to use the Google services, right? I don't see it really continuing to drop a lot. Salesforce is also a new company that I decided to get exposed to, right? This kind of sector, but yeah, it dropped very nicely. My first buy was here, a 20% drop. Then I dropped a little bit a smaller share here, 4%, because I thought this one is going to decline, and I was right. It declined even further. So this company is a little bit flawed because like its PE ratio is 40, right? It's very big. I really think this one can drop a little bit lower. I'm not so sure of that investment right now, but I'm going to keep looking at it. Microsoft is also one of my best investments here with an average price that reached around 68% profit at the all-time highs. But my last buy for 2 shares were somewhere here, right? And I haven't bought the dip on Microsoft simply because I have a lot of shares in Microsoft right now. I have a very good average price. So I'm only willing to buy this one if it really drops. Like for example, 21%. If it drops to around 30% in between this area, I will definitely be willing to put some in. But right now my priority is Amazon and Google. And for example, Nvidia. All right. Visa, another amazing company that I do plan to put more in. It's tapping the daily moving average, but I didn't buy it from here. And right now, if it of course starts dipping below the 300 level, I will put in my first buy on Visa. Amazing company, amazing financials, and I have been like very happy with this investment. It also had 72% at the top. Waste Management, another very defensive stock, also having a very good average price. So this one I'm only gonna buy. I did bought here the dip, 5 shares somewhere here. It pushed, but right now if it keeps dropping below all these levels, I'm again gonna buy because the financials are very strong, right? Procter & Gamble is an investment that has been really choppy here in terms of its price action. We have to look at the financials, like its earnings here. I think they have missed a couple of earnings right here, and you can see they're always missing their revenue, not the earnings. So they're not making as much revenue. I was really thinking to sell this company as well, but I still kind of believe in it. Although again, if you zoom out, like since pretty much here, since 2021, it hasn't really grown a lot, right? Unlike some of the tech companies, but I think it's a good company to have on the defensive side of things, right? So I'm gonna keep it. And I have Coca-Cola that I really wanted to buy down there, but I'm not a very huge fan of Coca-Cola, but that was a great investment that I could have taken, around 20%. But right now it's again dropping, but I'm not really looking to buy it. I have a very good average price all the way down there. So I'm only gonna buy if it starts dipping below this level. This company I want to sell. I bought it in this consolidation here, and right now I've lost 20% on it. Really not happy. Industrial real estate looks like it's getting a big hit. I not like it being in my portfolio. Realty income is a corporate, I believe, real estate. This one again not dropping, but this one is paying dividends every single month. So again, I do believe I can stack a little bit more below these lows. These ones are not invested. And of course, you know, VUSA, the S&P, I'm gonna be buying. I explained where in the S&P part, and I have a very big watch list as well of companies that I want to buy, but of course I'm not gonna talk about that. Maybe I can make some more videos if I actually buy them. So guys, I hope you enjoyed this one. I hope it was refreshing and maybe a little bit too long, but I just wanted to really talk through everything that I'm doing right now, also for myself to document, to see what I'm currently buying, so then maybe after 1 or 2 years when I come back to check it out and see, goddamn man, good job, that was a good decision that you made. Let me know if you found any value from this one. Let me know if it was helpful, and let me know if you want to see more videos on stock investing, not only trading analysis and stuff like this. Again, hope it was insightful. Let me know if you want to see more. I wish you good luck. Make sure to put some money into the market. Again, not financial advice, but opportunities like this don't come around very often. And if you really want to be deploying your cash to work, okay, you should have been smart until now to really stay cash, to really save up money, separate like 20 to 30% of your earnings, right? And then of course, when times like this come in, that is when you take out of your savings and you deploy them into the market, into some of the best companies in the world. Hope it was insightful. Let me know in the comments, and talk to you in the next one.